We'll get underway. Welcome. My name is Peter Gardette. I am the managing partner, CEO of Nareva, and welcome to our Whiplash Refresh webinar. So why Whiplash Refresh, besides the fact that it's fun to say? Even just 6 months ago, as we were looking at putting together the model updates, we realized that just in April, the world looked very different. What we were looking at then in April now seems like the end of an era of relative stability in energy market pricing. And as we looked at the increased evidence for fragmentation in energy markets, it's become increasingly apparent in both the short-term and long-term prices that we look at here at Nareva that you're seeing this kind of disruption. And we've been excited by the challenge to put numbers around those challenges. So just running through the agenda very quickly, Nareva is covering power, capacity, environmental attributes, and fuels markets. And we'll cover all of those today, our updated forecasts. When I say we, this is the team that will be speaking today. Our emails are on there. Please feel free to reach out to us. Now, as a programming note, this is the first Nareva webinar presentation, and we will be sharing the slides and we will be taking questions. You should have a question bar on your side panel. We'll collect those, but please feel free to reach out to us directly. We can raise questions with the analysts either at the end of this presentation or individually. Now, many of you will be familiar with Carbone Research. We are the same entity, now under a new name, with a broadened mission to provide essential data, analytics, and insight to energy transition markets. And what we care about in the end is the price of energy, from the broadest benchmark to the most specific transaction. And we're building on nearly 2 decades of experience as Carbone Research to bring you these updated AI-enabled pricing and forecasting tools. Now, the question of energy prices is always an important economic issue, but the kind of nitty-gritty details of US power and environmental attributes markets have rarely featured at the center of those economic debates. We've had decades of slow growth in US power demand and this kind of overhang of aging infrastructure, which meant that some of the most important US energy markets like capacity and RECs were sidelined compared to core energy markets. Now, energy demand is back, not just because of AI, but supercharged by data center load growth, and environmental markets are under increased regulatory pressure. So what we're finding is that the price of attributes is increasingly determining the price of energy. And today we'll talk about our latest forecasts. This is the result of our analyst interrogating models built on deep transactional data, as well as proprietary fundamentals analysis, and using the latest coding tools and AI practices. Now, our clients, many of you are on this call, already know how we got here. We're living at this pivot point. We're in the long shadow of regulations and market designs that were intended to shape US energy markets for a reality that really is no longer valid. As we enter this new market reality, we're finding an environment where supply is always short, where capacity, as much as energy, determines bankability, where states are reworking their RPS programs all the time. And we believe that a new approach to modeling is required. We've laid out some of our assumptions for our model updates in the previous slide and here in looking forward. Again, the slides will be available for everyone on this call afterwards, and we look forward to discussing them with you. In the meantime, let's get to the meat of the discussion. So we'll touch quickly on power, because at the heart of every forecast we'll discuss today is the energy part of the power market. This is the bulk of the actual flow, and while attributes give us advanced signals and they shape power use and supply, into the end, we have to come back to the hourly power price. And power modeling, power price modeling, is a discipline that's made huge strides in recent years. But with the advancement of data science, artificial intelligence, and machine learning, it is possible to get much more granular and to build out what we believe is a much more actionable view of future power prices. Our market analyst, Malachi Coleman, who's joined us here, has been working closely with our power modeling experts to enhance our view on hourly pricing forecasts using some of the most advanced tools available. With these tools, we're looking for breakout views, for divergence from the steady state forecasts you've probably seen a lot of other places, and for more ways to incorporate more trading information, which is really kind of the special sauce here at Nareva. Malachi, you've recently worked a lot on our NISO models, for example. That's the New York ISO. What are some of the challenges you faced in modeling this, other analysts are facing as you build these power forecasting models?
Thank you for the introduction, Peter. And I'm glad you're asking this question because I think it highlights the dynamic that we're seeing in energy markets right now. We're at a critical time where demand is projected to increase dramatically and the grid mix is shifting as more renewables and storage come online. So the challenge that we face from a modeling perspective is that the historical patterns are diverging from the future trends. People often say that power prices follow gas prices, at least directionally. And although that remains true to an extent, it captures a much smaller fraction of the big picture than it used to. So as renewables and storage come online, the system changes. In New York, for example, we expect that the system will shift from summer peaking to winter peaking within the next 15 years. So for dispatchable generation, which relies on fuel prices, that means that the average fuel price is becoming less important than peak pricing as utilization rates decrease. Simultaneously, as these utilization rates decrease, the capacity payments become more valuable. On the flip side, for renewables, as peak hours mean sometimes negative pricing for renewables and the market becomes saturated, those REC prices become even more valuable. So at Nareva, we're taking a blended approach to modeling power prices, where we're understanding these markets from a historical perspective with machine learning models that capture the patterns, but also looking at dispatch models which reflect market trends and determine clearing prices in the long run.
Nice, thank you, Malachi. Now turning to something that many of you are more familiar with when it comes to Nareva and to Carbone is capacity markets. And for many people in the energy markets, there's the time before the 2024 PJM capacity auction, and then there's the time after. Before that auction, prices for many capacity products were climbing and volatile, but the only market that seemed to struggle with capacity, particularly, was California. That PJM auction was a sign that the intersection of resurgent demand, shifting interconnection queues, and stifled build-out was coming to the rest of the country's energy markets. Now, everyone across organized power markets took a harder look at their capacity forecasts and realized, I think we find universally, that they were shorter than they thought. But right now, as the slide says, Nareva's modeled forecasts demonstrate that gas and batteries are battling it out on the, I would say, all-important US energy price horizon. US capacity markets are the forward signal that drives essential investment in the AI economy. And our power and capacity analyst, Philippe Schicker, is here to talk us through the new model and some of the implications for US power markets, capacity markets. So Nareva takes a pretty unique approach to modeling capacity, and that approach has, I believe, paid off as the background for price discovery in SPP and MISO in particular has become more volatile. How are you, Philippe, approaching modeling capacity in this update, and what should clients know as they look at these prices?
I think you need to know this like as good as anyone. We started looking at these markets and looking at modeling these. We took a very granular approach, and that was really intentional in the beginning. We wanted to make sure that when we build these models, we can change things granularly and on the fly. And so we started with the fundamentals first perspective, looking at existing supply, looking at interconnection queues and retirements. But for each of those, like very granularly, on the interconnection queue and retirement side, we looked at asset by assets to get an understanding of the existing supply and prospective supply that will or will not come online. but very quickly realized that this kind of approach was not going to be enough to match what we see and expect in these markets. We talk to our colleagues here on the other side at Carbone, and to talk to some of these brokers to get an understanding what these markets actually look like from people who are actively in these markets. And you and I across the team, we have conversations with our brokers and traders to understand where these markets are going, and that's very, very clearly influencing the way we model these. Right, we layer in policy insights like an OVVA, federal policy changes, but we also look at true trading and true brokering to get an understanding of where these markets are moving in the near and medium term, to apply the same kind of granularity across the board for the long-term horizon as well. And some of the things that are being highlighted here on the slide is that with that comes very granular movements on how we expect supply to function across the time horizon. And as we're seeing, like you just touched on, the kind of battle between batteries and gas, we are trying to modulate how true these changes are actually going to be happening in these markets.
Very true. So thinking a little bit about SPP, diving in, this is really, I think, where we talk about natural gas. Lots of market analysts, it's not hard to find notes that will tell you we're in a gas boom. And the interconnection queue does bear that out to some degree. The implications for capacity prices in particular are significant, especially in regions like SPP. In your view, how realistic are these gas queue additions? And how does the model and the market go about handicapping those interconnection additions?
Yeah, I think it's really fair to ask, right? We're seeing when we go to these conferences and talk to people, there's a lot of people asking these same kind of questions, right? Like, we're seeing a lot of gas in the queue. Will this meet the demand that we're expecting? Will this be enough for the demand that we may or may not see? And I think it is at least a directional indicator that when we see such a bulk increase in gas, that some of it will naturally materialize. I think 6 months ago, when we looked at this, we were seeing an appropriate amount of gas in the queue that then ended up leading to a stark price increase because it didn't match the kind of demand that we were also seeing. I think SPP, really many regions across America have made a concerted effort to move things faster through the interconnection queue, or at least come up with ways to make things come online faster. But that gets stifled by realities, right? You have spoken to people at some of these manufacturing companies that are talking to us and telling us that we're not going to increase our turbine output. And so many of these gas additions are stifled by the actual true physical infrastructure that is required to build these. And so I'm not expecting to have all of the gas that we're expecting to see in this queue materialize, but we're seeing some of this. And so we're shifting our expectations on how the realization rates move throughout the queue, and we're shifting those downwards, especially for gas.
So when you and I talked, as you were putting together the curves originally, it was really striking the degree to which the early 2030s get a price shift. And if you look at the fundamentals you've modeled here, it really speaks to the degree to which capacity is a marginal game. It doesn't take much in terms of oversupply to really drive prices lower. And the biggest direct competitor we see for capacity revenue from gas is batteries. What's really changed here in the battery deployment outlook?
I think that when we enter these conversations with counterparties who are on the battery side, they're seeing much more mature battery financing options, and we're seeing this kind of across America, really. We'll touch on this in just a second when we get to MISO as well. But the kind of existing understanding of batteries, the difficulties that are around kind of gas build out, make batteries just so much more attractive. You have a need for dispatchable capacity resources, and batteries fill that gap meeting, like kind of avoiding some of these hurdles that gas hits. And so that's where you're seeing this giving and taking between gas and batteries. And sure, our comparisons here are in, our forecast here is in comparison to the one from 6 months ago. But it is historic. It's worth noting that even though we have some supply decrease from OBBBA and a similar demand outlook, we're seeing near-term prices fall because we're seeing such an uptick in batteries and gas, which is moving some of this accredited capacity upwards, like you were just saying.
Yeah, for anyone who's wondering, when you see O3BA in our slides, that's the One Big Beautiful Bill Act. It's kind of our internal code. Everyone, I find, has their own way of referring to it, but we've chosen that one. Moving from the simple to the zonal, we talk a lot about how SPP is a black box for many people, but MISO has an active capacity market that you can dive in on zones, on zonal trading dynamics. You can dive in across different seasons. We do see much more impact of the US gas boom in some parts of the forecast for MISO than others. How are these regions and seasons differing?
Yeah, I think the things that are happening in SPP are similar to the ones that we're seeing in MISO as well. If we look from a kind of a larger perspective, SPP is shifting from just a summer peaking market to now summer and winter. And that same kind of shift is happening in MISO. Usually MISO North, which is the way we're modeling MISO, all 4 seasons, and then a north-south separation. MISO North summer has been the one historically that has been a bit short, being helped out by the south. That kind of trend is shifting similar to what is happening in SPP. Not only do we go from just the summer, but also summer and winter, but we're also seeing kind of a convergence of these two zones where we're seeing prices move closer to one another when it comes to the north and the south, and when it comes to summer and winter. And so even though we're seeing some decrease in the way we expect the curve to move, this is still touching on a general price inflation and price upwards pricing shift from the current realities. And a lot of that comes from additional battery realizations, additional gas in the queue, but all of that won't happen until, especially on the gas side, won't happen until the 2030s when the kind of turbines that we're expecting to come online will actually do come online.
Yeah, timing is important. And so bringing this all back together, let's maybe walk through some of the implications of these volatile times you're discussing for market participants, especially on the financing and developing side of things. We spent a lot of time talking to those guys. And with changes this sweeping, to look at the percent change merchant curve for SPP there on the right-hand side, from 1 year or 1 season to the next, how useful is forward capacity pricing as an investment signal?
I think from all the things that we're seeing, capacity will continue to be a major signal. The queue additions that we're seeing are not for nothing. Right? There's a general, I think, confidence in these markets, especially in the regions we just talked about, that capacity as an investment signal is majorly important. We have shifted away from power and RECs to capacity being really, really a premium product. That is driving a lot of investment decisions. And we've seen and talked to counterparties that have started to finance exclusively on the back of capacity. And so even though you're seeing some shifts or some percent changes on the chart on the right that seem quite volatile, the general trend that I want to underscore and that I should highlight here over and over again is that even though we're seeing changes from 6 months to now, it was the comparison that we're making, the general pricing trend is still upwards. We're still seeing an upwards pricing pressure from where we currently are and where we expect to be. And so that should not be discounted and should really rather be I think, a signal. I think your background, Peter, is an economics background, and you've been in these markets for a bit longer than many of us have been. Do you have a different outlook, or are you seeing similar trends?
I would say my view is additive to yours rather than different. the thing we have found is that people are taking a lot of risk with power assets these days. The pricing forecasts across energy using usage of PPAs, you mentioned RECs, which are still vital, but also quite volatile in the outlook. And so you have to be able to contract view finance across a much longer period than you might have at one time. It used to be you could possibly take a 5 to 10 year risk and then sort of push all the pricing risk into the back end of the curve. And what we're finding, you're in a lot of these discussions, is that that is no longer the case. Banks, investors, long-term asset holders want to see something in that dark part of the curve. And so even where pricing is imperfect, we do get a lot of demand for it. So yeah, additive rather than subtractive. But this is, I think, we've mentioned RECs a couple times now, a good opportunity to move onto the REC side. Many of you will be familiar with Carbon's leading position as a RECs trader. We're talking about renewable energy credits here. So I want to bring in Beste Elverde, who is our lead renewable energy credits analyst. With RECs, we are focusing today on 3 markets, some of the biggest compliance markets in the country: the PJM RECs market, the NEPL RECs market, and the California PCC1 market. So when we think about PJM and NEPL, they're both at kind of similar crossroads. The big question is about the potential for regulatory contagion. We've incorporated some of these potential RPS changes that are kind of dominating the talk in the market. That those RPS changes in most cases would represent demand destruction events, and we're incorporating those into our scenarios. But it's notable that even when we do that, the supply-demand balance still remains in favor of pretty stable RECs pricing across these key markets. We had just had an election yesterday. We're going to get into that a little bit in some of the key PJM states like Virginia and New Jersey, and what that means for RECs. But I think the bigger question many RECs market participants who are focused on the short term haven't considered in detail is that long-term lack of supply. That it's getting harder, not easier to build in many of these states, to build renewables as well as fossil fuels. So I want to bring in Beste Elverde. She's the senior analyst on the REC side of Nareva. Beste, you've divided your analysis into different time periods as much as different products. Why take that approach?
Yeah, thanks for the introduction, Peter. So in this refresh, we actually saw 2 distinct stories in our curves with sort of different fundamental trajectories. We have one at the front of the curve and one further out. And we essentially wanted to use these time periods to show how the market moves from constraint to maturity and what drives that shift, whether it's policy, financing conditions, or interconnection queue dynamics. So in the near term, what we call the short years, everything is driven by constraint. Offshore wind no longer exists, the queue is still oversubscribed, and the financing landscape changed with the OBBBA phasing out tax credits for solar and wind. And all of these end up slowing down new build out and tightening supply, which keeps prices supported there. So you can think of it as a business as usual setup, sort of continuing the theme of RPS programs not functioning as intended as of late, proven by limited renewables build out and higher ratepayer costs. And then as we move into the 2030s, the story changes there. The queue is not a bottleneck anymore, and the market is adjusted to the new financing conditions. So post-2030s is also when a lot of Class 1 RPS targets begin to plateau, which softens the demand side there. So we kind of start to see the diverging path from that point on, with Virginia staying short and bullish, largely due to in-state requirements and the aggressive demand, while others level off into a more balanced and bearish outlook.
In PJM, when you look at the longer term horizon, how should people be thinking about PJM across the back half of this forecast, particularly when it comes to legislation like the Press Act, which is something we've talked about quite a bit on the desk?
Yes. So the next decade is really about constraints in our forecasts, and that is both in physical build out and in policy. So on the supply side of things, we have the interconnection delays, offshore wind pullbacks, and the tax credit phase outs. And the queue realization is still under 20%, with projects taking more than 5 years to move through the interconnection queue. And that kind of keeps most of our tier one markets short into the early 2030s, especially with the absence of offshore wind. And on the demand side here, data centers have become the big story, especially in Dominion and PEPCO zones, where they're driving steady load growth. So that continues to increase demands even in the absence of increasing RPS targets in some states. And then there's the policy uncertainty that you touched on with New Jersey altering its RPS targets and the Vitol petition, which could open up Class 1 eligibility to out-of-state solar. So this uncertainty itself has created thin liquidity where market players are hesitant to take long positions until there's clarity. So the market is constrained here, not just by supply, but by uncertainty as well.
Interesting. It's almost like a feeding on itself, right?
Yes, certainly.
So turning to the NEPL market, another one that's been really in focus and where there is potentially quite a bit of regulatory risk. We've had a lot of discussions on the team about offshore wind in particular. As you know, I've been pretty cynical about additions of offshore wind in the United States, but you've taken what I think of as more of a middle of the road approach here, incorporating some, but not much offshore wind into the forecast. Exactly how much impact does offshore wind have on the pricing outlooks and the models here?
Yeah, that's a great question. Offshore winds can absolutely change the shape of our pricing curves here because of the large nameplate capacities that they have and the fact that it's a cross-qualified technology across different Class 1 markets, both in NEPL and PJM. But yeah, for this forecast, we decided to keep it more realistic. We did include Vineyard Wind, which is fully online and priced in. But further than that, we assume very little new offshore capacity, mostly because most secondary projects have been rebid or delayed because of cost inflation. And now with the loss of IRA era credit support under OBBBA, so we wanted to keep our supply outlook here more credible with this choice since layering in that uncontracted offshore volume would overstate the downside risk here. So over the next 5 to 10 years in our NEPL forecasts, the markets are supported by Vineyard Wind as well as imports and the legacy solar conversions in Massachusetts. But beyond that, we don't add more offshore wind in our base case. So our curves show a more balanced outlook that is bearish leaning.
Interesting. On the longer term forecast in NEPL, it's surprisingly stable, I think, for those of us that have been watching these markets for a while. The future will look more like the midterm, no major breakout events. Now, one of the things that was striking in the analysis you wrote up was the sheer number of programs that are ready to launch or in final development across NEPL states. That may have a big effect on the back end of the forecast that we're looking at. Do you see these programs as responsible for that price stability?
Yeah, exactly. So stability is just for our base case, as we can see in the chart here, but we do have a wider range between our cases for this refresh because of the recent policy changes that we've seen in the market. So for the first time in a decade, a NEPL state actually altered its RPS path when Connecticut adjusted its Class 1 targets due to ratepayer cost pressures, similar to what we've seen in New Jersey. And that broke a long pattern of kind of steady pricing that hovered near the ACP, and introduced real uncertainty in a lot of our NEPL markets. And this goalpost shifting could be followed by Massachusetts and Maine as well, which we did incorporate in our forecast, essentially freezing the RPS growth for all of these states. And that kind of ended up widening the spread between our three cases here and really showed us the real downside risk in our NEPL markets. But if the goalposts don't shift, we go back to business as usual, as we can see in our base case scenario here. So a gradual softening with the incoming supply, but still a policy anchored kind of balanced market. So even though NEPL looks steady overall for the first time, we are seeing a real policy risk here on the demand side.
And as things steady, do you think we'll see a resurgence in trading volumes on further out the curve?
I think so. I think that a lot of market players are kind of holding off, especially towards the later vintages. There's real uncertainty. So we do expect more liquidity once we get more certainty in the market and more RPS stability.
Nice. Just talking about RPS stability, we've decided to carve out our analysis of CAISO REX markets, and we do have those merchant curves as well. And we're going to just, in order not to consume the entire webcast with talk of CAISO in California, we're just going to highlight the PCC1 update here. California really does remain its own market when it comes to renewables and environmental ambition. And our backwardated forecast here is really indicative of that increased ambition. Besides the robust pricing based on structural undersupply, the other characteristic of California compliance markets is complexity. Every year, there's a new program, a new acronym, a new sweeping set of revisions. Malachi, thanks for joining again. You've been spending a lot of time looking at California energy and environmental markets recently. What is with the latest with PCC1 and what's new in our updated merchant curve forecast here?
Sure. I think a primary driver for this curve shape that we're seeing is California's revision to their interconnection queue process. They underwent a major revision to the cluster study procedure, and what we had initially looked at as roughly 350 gigawatts in the queue has been narrowed down to about 50 gigawatts with a distinct decrease in solar and wind. So that's really driving this price increase in the near term and that undersupplied dynamic. And then in the mid part of the curve, what we really see there is increased transmission from neighboring states in California. We expect roughly 6 gigawatts of transmission capacity to come online within the next few years, and that'll really stabilize prices. And then looking at the back half of the curve, we expect that over procurement for PCC1s will continue to be the case. Historically, that has been true, and we expect that trend to continue, particularly for CCAs, as they have agreements with their constituents that cause them to over procure for PCC1s, despite not necessarily needing to from a regulatory standpoint.
Can I double click on that over contracting point? I think this evolution in contracting has actually had an impact on our forecast, and it's one of the places where it's very clear the way that we're incorporating market insight into the forecast beyond just fundamental views.
Certainly. An other interesting part of this PCC1 forecast that is similar to the CCA dynamic is that roughly 3/4 of PCC1s generated are already tied up in long-term contracts. So what that means in the spot market is that it can be very illiquid and tipped either way from the supply side or the demand side, depending on which one is becoming on edge. So that dynamic we see will continue to be the case in the future.
Yeah, no, I mean, California is its own world. Thank you so much, Malachi. We'll wrap up today by talking about fuels. So clean fuels is another area where Carbone has a long legacy position of leadership, and I'd like to turn back to Veste, and she's also leading across our growing fuels market analysis. And I wanted to ask her some questions about our probably what's been our most in-demand forecast, which is for D3 RINs and across the decode market. For such a tumultuous year in fuels regulatory outlooks, I would argue that markets have actually remained remarkably steady when seen over time. Individual sessions, individual weeks are very dynamic, but when seen over time, overall positions tend to revert back to fundamentals. And that's been particularly true in D3 RINs, where Nareva has been especially active in forecasting the underlying renewable natural gas fundamentals, and where the price of the federal attributes is still high enough to draw in new supply. Now, the big constraint we've seen, of course, in D3 RINs monetization isn't political, it's physical. To earn RINs, you have to use the gas to fuel CNG transport, largely trucks and buses, and that fueling infrastructure is limited and slow to turn over. Besta, you've spent a lot of time this year thinking about CNG dispensing and share ratios. How do you think about those aspects? Where are we going with CNG dispensing and the impact on RINs prices over the coming decade?
Yeah, as you mentioned, Peter, CNG is basically the gate that turns RNG into RINs. And right now, it's where the system is getting stuck, which is why we've been spending a lot of time thinking about it. But I personally think about it in three parts, which is fueling capacity, geography, and contracting, but all point to the same issue, which is that we are running out of room there. But on the fueling capacity side of things, RNG output keeps growing, but the number of CNG stations and how much they can compress or store hasn't kept up. And the network is already running near full utilization with maybe around 10% of the market left. And developers won't build more stations until they see demand, while fleets won't commit until supply is guaranteed. So it's like a classic chicken and egg problem there. And geographically, the high traffic corridors are already saturated, with other regions having very little infrastructure. And then there's contracting. It's gotten really hard to secure long-term access within the CNG market right now. And with the current bottleneck, most CNG offtake is month to month, and long-term agreements are rare. And that makes it really tough for projects to get financed or guarantee their RIN output. And if RNG can't move through a CNG nozzle, it doesn't end up earning a RIN, and usually ends up in lower value voluntary or utility contracts there. So our forecast for CNG capacity shows that at current growth rates, we could run out of CNG dispensing capacity in just 2 to 3 years. So until someone builds ahead of demand or unlocks new corridors, we expect D3 prices to stay supported by these infrastructure limits.
Mm. We talk about support in this market, and yet volume has been quite low as people have kind of waited for some sort of green light on the regulatory side. We look to widen the aperture to the broader decode markets and to other clean fuels. Is there a breakout moment coming for RINs? What should we watch out for to set that next big price move?
I definitely think that the setup for the breakout moment is there, but it depends on two things lining up, which is policy clarity and fueling infrastructure. And on the policy side of things, everyone's watching the final RVOs and the reallocation and CWC guidance for D3 RINs. For 2024, EPA has already exercised its waiver authority. And for 2025, another partial waiver is on the table, with CWCs expected if finalized. And CWCs here act as a ceiling on D3 prices. So if the issuance is delayed or limited, that ceiling lifts, especially if the RVO targets tighten at the same time. And the second piece here is the fueling capacity. Even with bullish policy signals, our D3 prices can't rally for long without more CNG dispensing build out. And just also wanted to note the soybean complex here and how it's playing a role here. The volatility there has pulled down the D4 and D5 prices, and that has been creating a downward pressure for D3 RINs as well. So structurally, the market is still tight, but once we get final RVO clarity and CWCs and even modest new fueling build out, I think that will be the breakout moment, sort of this shift from policy stagnation to infrastructure rally.
Very helpful. Before I let you go, you as the Rex person, just to turn our minds back to that, we had some big state level elections last night. The results came in. We have Democratic governors and sweeps in Virginia and New Jersey, which are major PJM states. How does that affect your view on Rex prices, just casually?
Yeah, it looks like these results are seemingly bullish for the state RPSs in both states. For Virginia specifically, I think that this means that there's no imminent threat to their RPS that the previous governor is pursuing. And it could also mean broader changes that would strengthen the RPS in this state, along with Virginia rejoining the RGGI program, which would prompt more renewable supply in the state. And in New Jersey, this could mean permitting for utility scale renewable projects could get easier. And they could also pursue committing the net zero by 2035 grid to law. But the impact on ratepayers is still a concern, especially in New Jersey, which is, I think, where the lines between capacity pricing and reg pricing get more blurry, and where reg pricing kind of hinges upon how well the capacity markets are functioning. But the news overall are a bullish pricing signal and very positive for renewables growth in a very uncertain policy environment we have for RECs right now.
Nice. Thank you so much. So thank you everyone for joining us today. As I've mentioned before, if you would like to know more about Nareva, or if you'd like to know more about these forecasts, please follow us, contact us, and we will be sending out the slides to everyone who attended today. Thanks again, and have a great Wednesday. Thanks, everybody.